Every financial crisis is sold to the public as an accident, a shock, a failure no one could have predicted. And yet, after every crisis, the same institutions emerge stronger, richer, and more powerful than before. Banks collapse, but central banks expand. Currencies weaken, but monetary authorities gain new tools. Citizens lose savings, but balance sheets at the top grow larger than ever. Here's the mystery. If crises are disasters for the economy, why do they consistently produce long-term profits and power for central banks? This is not a story about secret meetings or cartoon villains. It's more unsettling than that. It's a story about incentives, about systems designed to turn emergency measures into permanent policy, and about how temporary fixes quietly become the new normal. By the end of this video, you'll understand why modern financial crises are not bugs in the system, but fuel for it. To understand how crisis became profitable, we need to rewind to a time before central banks dominated the global economy. For most of history, money was tangible: gold, silver, coins, and later paper notes that could be redeemed for something real. They could fail, and often did. There was no institution powerful enough to backstop the entire financial system. That changed in the late 17th and early 18th centuries. Governments were fighting expensive wars. Taxation was politically dangerous. Borrowing from wealthy elites was unreliable. So a new idea emerged: create a central institution that could lend to the government, manage currency, and stabilize markets during panic. The first modern example was the Bank of England, founded in 1694. It was sold as a solution to instability, but embedded in its design was a quiet innovation, one that would later reshape the world. For the first time, crisis itself became a justification for expanding monetary power. Central banks were given a specific mandate: step in during emergencies, lend when no one else would, print money when liquidity dried up, stabilize markets during panic. This sounds reasonable, even necessary. But here's the crucial mechanism most people miss. Every crisis expands the definition of emergency. And once a power is granted in a crisis, it is almost never fully revoked. Originally, central banks were lenders of last resort, stepping in only when banks were solvent but illiquid. Over time, that line blurred. Illiquid became insolvent. Temporary became indefinite. Emergency became routine. And with each crisis, central banks gained new tools: larger balance sheets, greater political independence, less public accountability. Crisis didn't weaken them. It legitimized them. The turning point came in the 20th century. Before World War I, most major currencies were tied to gold. This imposed limits. You couldn't print endlessly. You couldn't monetize debt without consequences. War broke that restraint. Governments suspended gold convertibility to finance massive military spending. Central banks printed to fund deficits. After the war, the system never truly returned to discipline. The Great Depression accelerated everything. Bank failures spread. Deflation crushed economies. People demanded action. Central banks responded with unprecedented interventions. Interest rates were manipulated. Money supply expanded. Governments and central banks fused into a single crisis management machine, and crucially, failure was reframed. Economic collapse was no longer a cleansing reset. It was a catastrophe to be prevented at all costs. That belief changed everything. After World War II, the global system was rebuilt around central banking. The Bretton Woods system put the US dollar at the center. Other currencies revolved around it. Central banks coordinated globally. But cracks appeared. By the 1970s, inflation surged, gold reserves drained, trust in convertibility collapsed. In 1971, the US severed the last link between money and gold. This moment is rarely framed correctly. It wasn't just the end of gold-backed money. It was the beginning of unlimited crisis management. From that point forward, money could be created without physical constraint. Debt could be monetized indefinitely. Crises could be postponed but never resolved, and postponement became profitable. Why? Because central banks earn power and sometimes direct income by expanding their balance sheets. They buy assets, they collect interest, they influence markets. Crisis justifies expansion. Expansion generates control. If there is a single moment that reveals the modern system, it is the 2008 financial crisis. Banks over-leveraged, risk was mispriced. Debt pyramids collapsed. The system should have reset. Instead, central banks intervened on a scale never seen before. Interest rates were slashed to near zero. Trillions were created digitally. Assets toxic to the private market were absorbed by public balance sheets. This was called temporary. It wasn't. Quantitative easing, once unthinkable, became standard policy. Central banks transformed from lenders of last resort into buyers of first resort. Markets stopped pricing risk honestly. Investors began front-running central bank behavior. And here's the critical shift. Crises stopped being moments of failure and became moments of guaranteed rescue. Losses were socialized. Gains remained private. That is not an accident. It is an incentive structure. Central banks don't generate profit the way corporations do. Their profit is structural. Every intervention reshapes the economy in subtle ways. Asset prices rise faster than wages. Savers are punished by low interest rates. Debt becomes cheaper than productivity. Governments delay reform. The result: wealth concentrates upward. Inequality widens. Dependence on intervention grows. And when the next crisis arrives, it always does, the system is even more fragile, which requires even more intervention. It's a loop. Not because central bankers are evil, but because the system rewards delay over discipline. After every crisis, reforms are promised. Stronger regulation, better oversight, smarter models, but the core structure remains unchanged. Why? Because genuine reform would require accepting short-term pain, allowing institutions to fail, reducing central bank power that is politically impossible. So fixes target symptoms, not causes. More liquidity, more coordination, more complexity, and complexity favors the institution that controls the system. Look at the last decade: pandemic shutdowns, supply chain collapse, explosive government spending. Central banks responded instantly. Balance sheets exploded again. Interest rates were suppressed. Asset markets surged even as real economies struggled. Then inflation appeared. The same institutions that created excess liquidity now claim to fight it. Rates rise. Debt becomes expensive. Citizens absorb the shock. The pattern is clear. Crisis gives intervention, gives distortion, gives new crisis. Each cycle leaves central banks more entrenched. Central banks do not need crises to exist, but crises justify their expansion. And once expanded, contraction becomes dangerous. The system is now addicted to intervention. Markets expect rescue. Governments expect monetization. Debt assumes eternal refinancing. This is how crisis becomes permanent profit, not always financial, but institutional. Power compounds. Takeaway 1. Crises are not random failures, they are stress tests that expand central bank authority. Takeaway 2. Temporary emergency measures rarely disappear, they redefine normal. Takeaway 3. The true cost of intervention is not inflation alone, it is dependency. A system that cannot tolerate failure eventually creates a failure it cannot control. The question is not whether another crisis will come. It's whether the next intervention will fix anything, or simply make the eventual correction larger. If you want to understand money, power, and the hidden mechanics shaping your future, subscribe to this channel, because the most important financial truths are never taught. They're revealed slowly, one crisis at a time, and the next one is already being prepared.